Welcome to the presentation on understanding the cash flow statement. The cash flow statement provides information about a company's cash receipts and cash payments during an accounting period, about a company's operating, investing and financing activities, about the impact of accrual accounting events on cash flows, and it allows us to assess the firm's liquidity, solvency and financial flexibility. An analyst can use the cash flow statement to determine whether regular operations generate enough cash to sustain business, whether enough cash is generated to pay off existing debts, whether the firm is likely to need additional financing, whether unexpected obligations can be met, and whether firms can take advantage of new business opportunities as they arise. So at this stage, let me mention the fundamental point with the cash flow statement. So this is roughly analogous to the income statement, but since we use the accrual basis of accounting when we come up with the income statement, there is a chance that the revenue that you generate is not equal to the cash that you receive from customers, and hence it is possible, if you have recognized a lot of revenue without having received cash, you have a high number for accounts receivables and a high number for net income. What the cash flow statement allows you to do is see how much cash you are actually receiving. And a lot of financial analysis happens based on cash flow projections, because ultimately that's what determines the value of an organization. So in the context of your CFA exam, it is extremely important to understand that the cash flow statement is divided into three components: cash flow from operations, cash flow from investing activities, and cash flow from financing. And you need to understand what activities need to be categorized where. So basically, CFO consists of cash resulting from transactions that affect a firm's net income, or more specifically the core operating activities of a firm. So for example, cash received from customers will be a cash inflow related to CFO. Cash paid to suppliers and employees is a cash outflow in this CFO category. Any money spent on various operating expenses. Trading securities, so if you buy securities that are classified as trading, so short-term stocks that you might buy, any interest that you pay and receive. According to US GAAP, interest paid and received falls under CFO. Dividends received, so if you've invested in stocks and you receive dividends, that would classify as CFO if you are using US GAAP. Taxes paid also fall under CFO. So you need to understand that under US GAAP, all these items fall in the CFO category. Cash flow from investing consists of cash resulting from acquisitions or disposal of long-term assets and certain large investments. So fixed assets or long-term assets, any money spent on them would refer to, we would call CFI in the cash flow statement. And when you sell those assets, the money that you get would be an inflow of cash documented in CFI. So any fixed assets and certain equity and debt investments. So if you buy a 20% stake in a given company, that would be an equity investment, and that would be considered a cash flow from investing activity. Similarly, if you issue a loan, that would so by issuing a loan, I mean you are lending money to an organization. So you are a bank and you lend money, that would be considered a investment. CFF consists of cash resulting from transaction affecting a firm's capital structure. So any debt and equity financing, any principal paid on debt. So you borrow money, that's cash inflow in this category, CFF. When you repay that debt, that again would be outflow of cash in the CFF category. treasury stock operation where you are paying money to shareholders, that's also CFF. Dividends paid is also CFF. Now, what are the differences between IFRS and US GAAP? You just saw that interest received under US GAAP is classified as operating. IFRS gives you the flexibility to categorize it as operating or investing depending on your business. Any interest that you pay, so you borrowed money and are paying interest, according to IFRS, this can be classified as operating or financing depending on your situation. And under US GAAP, this has to be classified as operating. Dividends received under IFRS could be either operating or investing. Under US GAAP, it has to be operating. Dividends paid, since this is money going to shareholders, IFRS gives the flexibility that it can be either operating or financing, whereas US GAAP insists that this is financing. These four are the most important. In general, just a quick comment on bank overdrafts. So under IFRS, these are considered part of cash equivalents. Under US GAAP, not considered part of cash equivalents. So they are classified as financing. Taxes paid in general, we can say, are considered operating. So if you recall from an earlier lecture, we have said that US GAAP is more rules-based framework, and notice that there are strict rules about how to categorize, versus IFRS is more principles-based, so there is more flexibility in this framework. Non-cash activities. A non-cash transaction is any transaction that does not involve an outflow or inflow of cash. So conversion of bonds to stocks, stock splits, etc. So non-cash transactions must be disclosed in either a footnote or a supplemental schedule to the cash flow statement. An analyst should incorporate non-cash transactions into analysis of past and current performance and include their effects in estimating future cash flows. So now let's talk about the CFO, and there are two formats in which the cash flow from operations can be presented: the direct format and the indirect format, which we will talk about later. In the direct format, we basically convert the accrual basis income statement to a cash basis income statement. So effectively we are saying that we simply need to record all the operating related cash that came in and all the operating cash that went out. Each line item on the accrual based income statement is converted into cash receipts or payments. The direct method begins with cash inflows from customers. So notice that the top line for the operating cash flow direct method is the cash collected from customers, and then the approximate equivalent in the income statement you would have cost of goods sold. The equivalent is cash paid to suppliers, and then all the cash paid for your operating expenses, the cash paid for interest. This would be interest expense in your income statement. Here it's called cash paid for interest. The cash paid for taxes, and after subtracting all these amounts, so say this is 100 and then cash paid to suppliers 50, and cash paid for operating expenses 10, cash paid for interest 10, and cash paid for taxes 10, your operating cash flow would be 50, 60, 70, 80. So this is 20. So this is the rough equivalent of your net income on the income statement. But the difference is that this is based on actual cash that comes in and goes out. Now let's just get a basic idea of how do we go from having a revenue number to figuring out how much cash is received. So some basic rules. Whenever you are dealing with a cash flow statement, you need to recognize that an increase in asset is a use of cash. So the way you can remember this is, if an asset value goes up, that means that the cash is used up. Look at this through a simple example. Say you start a business and initially let's say that your cash is equal to 0, and let's say your inventory is worth 20. So this is, let's say that at the start of the year 1 Jan 2010, cash 0, inventory 20, and let's say your accounts receivable at the start of your business is 0. Then during the year you sell this inventory for $30, but all this sale is really a receivable, so your customer does not pay you. So your accounts receivable, which is an asset, goes up, and at the end of the year your accounts receivable now becomes 30. Okay, so how much cash did you receive from customers? The simple way of looking at this is the cash from customers. So cash from customer is equal to the revenue, which in our case is 30, minus the change in asset or change in accounts receivable. The change in accounts receivable is the ending balance minus the beginning balance, which is the end 30 minus beginning 0. So the cash received from customers in this simple example, as you can see, is 0. So the 2-3 main points to understand here: any increase in assets, such as increase in this accounts receivable. So increase in asset is a use of cash, which means that you have to subtract the number. On the other hand, increase in a liability is a source of cash. That means that you would add the number. So increase in liability is a source of cash. So the simple table that I would encourage you to learn is asset goes up, that is use of cash, which means negative. Asset going down then has to be the opposite, which would be positive. So the way you can think of this, in the subsequent year, if accounts receivable really went down from 30 to 0, that means the cash extra 30 came in. So you would then be adding that to the revenue. So now what about liabilities? If liability goes up, that from a cash flow perspective is a good thing. That means cash coming in, and liability going down is a use of cash, because simple way to remember it is, if liability goes up, that's a good thing. You are not paying your, from a cash perspective, that's good. So you add to cash. And if liability goes down, that means you are paying off your suppliers, for example, and you put a negative related to cash. So make sure you learn this very well. Okay, so now let's do some basic calculations. Cash collection from customers. The way you would do this is, from the income statement you would look at revenue, and let's say revenue is equal to 100. And as I just explained, let's say that your accounts receivable, your change in accounts receivable, let's say is 20. This means that the end value of AR minus the beginning value of accounts receivable, let's say is $30 at the end, minus the beginning value, which is 10. So this is 20. So your accounts receivable went up by 20. That means your cash collected from customers would be equal to revenue 100 minus the change in accounts receivable, which is 20. So in this particular case, the cash collected from customers is $80. The cash paid to suppliers has two parts. So with cash paid to suppliers, you first look at cost of goods sold. So this would be COGS, which you get from your income statement. And remember that COGS is an expense. So let's say that COGS is 50. So let's just take this as a negative, because cost of goods sold is money out. And then the two items that you look at for cash paid to suppliers, the first item is inventory. So inventory is an asset, and let's say that in our particular case inventory increased by 5. So if you recall, increase in asset, since inventory is an asset, an increase in asset means that we have used up cash, so that's minus. So since we are used up, inventory went up by 5, that's a minus, so we put minus 5 over here. And the other thing that we look at is accounts payable, since accounts payable is related to payments that we make to our suppliers. So let's say that accounts payable, which is a liability, let's say went up by 10. So an increase in liability is actually a positive, so that is a source of cash. So then we put plus 10. So the overall cash paid to suppliers is minus 50 minus 5, which is minus 55, plus 10 gives us minus 45. So the cash paid to suppliers is minus 45. So the formula that you can think of as the cash paid to suppliers then becomes our COGS, and remember that since this is an expense, take it as a negative number, and then you subtract the change in inventory and you add the change in accounts payable. So that's your cash paid to supplier. Cash paid for operating expenses, again the idea is the same. In our simple example, let's say that cash paid for operating expenses, that you paid for all this in cash. If not, then you simply take your your expense from the income statement and then adjust it based on changes in the relevant assets and liabilities. Cash paid for interest. So here again, from the income statement, say your interest expense is equal to 10, and since this is an expense, we'll call this a negative number. And then let's say that your interest payable went up from 5 to 7 during the year. So what is the change in interest payable? The change in interest payable is end minus beginning, which is 7 minus 5, which is 2. Remember, this is a liability. An increase in liability is a source of cash. So you do minus 10 plus 2, which is the source of cash. So you have minus 8. So the cash paid is 8. Similarly, cash paid for taxes, you look at your tax expense from the income statement and changes in taxes payable and make the necessary adjustments. So essentially what you are doing is figuring out your cash collected from customers, subtracting all these expenses, and then coming up with your operating cash flow. So as you see, this is like the income statement, but we are looking at actual cash coming in and actual cash coming out to see overall how much cash we generated from our operations.